Our last speaker, and thank you folks for your patience. I did tell Dave this would be the best slot, as you'd all remember exactly what he had to say as you're leaving. Our next speaker is Dave O'Meara from Greenman Investments. Dave is a taxation expert and is head of investor relations in Greenman. So I'll hand you over to Dave.
Thanks, Alan. First of all, thanks to Alan and the team in Finance One for the opportunity to address you all tonight. I'm conscious it's a lovely sunny evening, so I'll cut down my speech from an hour and a half that Alan allotted to me to an hour and 20 minutes, so you might get the last of the sun. My colleagues in the panel have kind of set the scene pretty well for the way the market is and the challenge that comes with trying to generate yield at the moment. So I suppose it's a good opportunity for me coming in last to just position Greenman and how we feel we can generate long-term, stable and consistent income for anyone's portfolio. And that's really what our mission is. Our whole focus is on income and trying to generate income for the long term and in a stable and very consistent manner. So that's our whole focus. That really dictates everything about the design of the company, how we're structured and what our investment focus is. So to allow us to do that, we're very much sector specialists. So compared to the other companies in the panel, we're very much a focused operation with a small and dedicated team focused on one purpose. Within that, we only ever invest in the German market. We feel Germany gives us the scale and has the economic fundamentals to allow us to generate income from real estate in a very long-term and stable manner. Within the German market, our speciality is within need-based or necessity-based retail. Really what we are after and what we focus in and what our key partnerships with are with Germany's largest and dominant food retailers. Those retailers give us long-term stable leases that allow us to generate income for long-term and long-term manner for our investors. What you'll see here, this phrase here, WALT maintenance. The WALT is the weighted average remaining lease term, and that's a really key focus for us as a property manager. We look at the average remaining lease term for our assets. So typically you see some pictures of the types of properties that we have here. These aren't Dundrum, they're not Kildare Village, it's not like Grafton Street. It's simple everyday shopping for people where you go in to get your necessities. And the nature of those types of properties allow us to have long-term leases with tenants whose performance isn't really correlated to performance in the general macroeconomy. Germans are always going to need to eat. They're never going to not be hungry. They're always going to need basic foods. They're always going to need shoes. They're always going to need basic pharmacy goods. And that's what our tenants focus on and where our rent and our income for investors is really generated from. Particularly these types of tenants give us long-term leases. So Edeka here and Rave are the two leading full assortment retailers in Germany. Typically we get 15 years, sometimes 20 initial year lease terms with these tenants. And that's good news for our investors because these are really strong, stable entities. How we're a bit different as a company, we have an operation in Berlin as well as Dublin. We have 14 colleagues in Frankfurt and Berlin offices, and their main function is property and asset management. Because we're dealing with the same tenants on multiple sites, there's a really good opportunity through our focus and our sector speciality to come up with asset management and property management strategies that can cater to these tenants across multiple sites. And the real benefit and knock-on opportunity out of that for our investors is that we can get lease extensions at an earlier stage than if we'd outsource this function to another company. And that's a really key point for us. So we are focused on adding new properties with long remaining lease terms to keep our remaining lease term nice and long. And also by working really closely with our existing tenants to try and get lease extensions, and all with the end goal of trying to extend the remaining lease term and extend the amount of time we can get income for our investors. And I'll relate all of this kind of theoretical stuff to our Greenman Open Fund as we go through. The nature of the tenants is really important. The key for all of our properties is having a really strong and dominant food retailer on the site, and these tenants really draw the footfall for the secondary tenants and the tertiary tenants. For anyone who hasn't spent much time in Germany, these first two names won't be very familiar to you, but Edeka and Rave are the two leading full assortment retailers in Germany. We're all very used to the discounters, Aldi and Lidl, but between these three and Lidl, they sell nearly 63% of all the grocery in Germany, so very dominant players in the market. Edeka and Rave are very much full assortment retailers, lots of selection, lots of emphasis on fresh food, fresh veg, the presentation of the food, the experience of shopping, versus the discounters, which is very much your hard discount, stack it high, sell it cheap, that we're used to here. They've even actually softened their approach a little bit in Ireland. Aldi and Lidl, you'll have noticed, with bakeries and that kind of stuff. But Edeka and Reva are used to dealing with the discounters since the 1960s, so they very much have a different segment of the market. So while they're in fierce competition, they also complement each other quite a bit. I'll use Edeka as an example. Edeka sell 26% of all the food in Germany. They're a cooperative of over 4,000 members with nearly 11,200 stores across the country. Turnover of nearly 90 billion in a year. So to frame it, I think there's about 130 Dunnes stores in the country. So there's always Edeka stores coming to near the end of their lease that need to sign up for new leases, that need investment, that need an investment manager like us to manage them. So that's the opportunity for us operating in a country with the scale of Germany. The key thing that our banks look at and that we look at is the chance of default for these retailers. To become a primary food anchor tenant in one of our funds, we look at Credit Reform. They're Europe's largest ratings agency, and they rate all companies, giving them a chance of becoming solvent in the next 12 months. So to become one of our food anchor tenants, the maximum chance of default per Credit Reform is 0.4%. But if you see here in the bottom lines, typically our dominant food retailers don't come anywhere near that, 0.08, 0.1. So while it's not guaranteed, as close as possible, we're going to get our rent from these tenants, which is really important to our goal to generate the rental income from these properties into income for our investors. A bit of a track record. Some of you in the room, I think, may have been investors in our previous funds, which are the Auto Accelerate and Retail funds. From 2009 up until 2012, we raised money for these funds, and you can see the equity commitments. The key for us is we always target 5.5% return, cash and cash return out of our funds. And you can see the average annualized returns from these funds. There's about 1,100 investors across these three funds. They all got their final maturity figures from us last November, and their exit options. So the range was about 8% up to 13% in some cases. So we were slightly ahead of target with the returns with these funds, and luckily about 70% of these investors opted to reinvest with us when they got their maturity options earlier on this year. This is kind of a busy slide, but I suppose I've given you a bit of background to who we are and what our whole focus is, but a bit of the nuts and bolts of the company. So what we're showing here is from the year 2006 up until last year. In the green, we show our assets under management versus our number of employees. So the company started off in 2005 with 2 employees and no assets, and now there are 25 employees, well actually 27 as of last week, managing 527 million worth of property. Since day one, we've had a focus on the German market, and that's always been key to us. We want to operate in one country and know it inside out. Quickly enough, within the first few years, we shifted our focus from residential to the commercial sector. The chances of getting a rent from 200 students versus the top retailers in Germany was quite apparent after a couple of years. These years here, from 2009 up to 2014, were really essential years for us. It was all about getting credibility in the German market. We didn't want to be seen as some Irish guys buying some property just to give it a lash and see how it went. We really had to work hard in those few years to build up our contacts, build up our base in Germany, and get credibility in the market with banks, with retailers, with property developers, with property agents, and all the people we work with every day and rely on. The last piece in that jigsaw was in 2014 when we got our AIFM license from the central bank. The Alternative Investment Fund Managers Directive came in 2013. It was the EU's response to the global economic crisis. It was their opportunity to regulate all collective investments that had previously been unregulated at that point, so private equity, hedge funds, and real estate offerings like ourselves. As a pan-European directive, it was immediately got us that last piece of acceptance we were looking for in the German market, and off the back of a lot of the hard work we did in those kind of 4 or 5 years leading up to that was we've seen a fairly large increase in our assets under management since then, and that's really due to our regulation and the structures we put in place in the lead up to that period with the central bank. A key point, I suppose, I joined in 2011, and I always point out at that stage there was 5 employees. There was 4 of us raising capital, getting the money into our funds, getting the scale in, and 1.5 people in operations. Now we have 27 employees. There's only 3 of us raising the capital, and the rest on the operational side of the business. So that just, I suppose, shows the story of the evolution of the company to where we are today. Post our regulation, which was the key milestone in the history of the company. I suppose we've undergone 2 years of restructuring of the fund. We've moved to an open-ended fund structure model, exited earlier funds, and to the point where we are today. So we have what we call our Greenman Open Fund, which is our flagship fund, and we have a 10-year strategy in place building the company around this fund. As we stand today, we have 25 properties in the fund, a volume of 355 million, a shade under 16 million a year in rent, and crucially for us, a WART of 10 years, weighted average remaining lease term of 10 years. If we were to do nothing, if we sat in our hands and let the leases wind down over the next 10 years, we'd collect nearly 16 million a year for the next 10 years. Our whole focus is to keep fundraising, that's my job, and my colleague Peter's job, to add new properties, to keep that WART figure nice and high, and then also to work on property management strategies to get lease extensions to also maintain this WART figure, so to keep this income coming for as long as possible for our investors. In simple terms, that's what we're trying to do. The breakdown here and the pie chart shows we've nearly 50% of the rent coming from our food retailers. They're really key to the whole model and the whole structure of the fund, and they attract the ancillary tenants in healthcare, household, auto service, fashion. But the nature of these goods is really important. You see here an example of one of our sites here. I'm trying to read it. I can't. I think it's in Crailsham, is it? No? Neuwied. Thanks, Peter. Typical of the types of assets we have: lots of car parking. Edeka is the anchor tenant. Rossmann, the pharmacy company, a cheap shoes retailer as well. Simple everyday stuff. These aren't places you go to hang out with the kids at the weekend. You go in, get your essential stuff, and leave. And that's really an important part of the nature of these types of properties for us. So, out of that fund, I said at the start, our whole focus is trying to maximise the element of the rental income our properties generate into income for our investors. So this pie chart here shows we have as of now, we have 15.9 million a year in rent from our portfolio. Where does that rent go? About 9% is what we call our non-recoverable costs, so the cost of operating the properties that the tenant isn't liable for, that the fund has to pay for. Another 18% debt service, the cost of our debt. So we target 50% gearing on all our funds. The max allowable is 60. It's currently hovering at around 48%. So that leaves us with 73% of the rental income we receive in a given year as free cash flow. So that's our whole focus. That's a nice high figure, 73%. Our whole focus as a company is to keep that figure as high as possible, maximise that proportion of the rental income we receive, because that's what we distribute to our investors. What we target to pay annually is 5.5% to our investors. So we'll pay a regular 1% distribution each quarter, and in Q4 of each year, the variable one, it should be, we think, around 1.5%, making a 5.5% distribution. It was 5.51 last year, so we were eerily accurate last year. Our target annualised rate of return, assuming someone exits the fund after 5 years, is 8% per annum. A real focus on the income. This is not a capital appreciation play. Key thing, we're not buying property for X, looking to sell it for 2 times X. This is a long-term outlook, and what we're really in is giving you consistent income from these tenants. A key factor we were looking at when considering what could affect our ability, and my colleagues in the panel kind of addressed this early on, a potential change in interest rates could affect our ability in the future to keep this free cash flow figure nice and high. So last year, with the way the banking market is, we had a really golden opportunity to refinance the full portfolio. So we drew down a refinance in the full portfolio with HSH Nordbank, Hamburg-based commercial lender, and we were able to avail of a 10-year facility that locked in our interest rates at a max of 2.25% for the next 10 years. So given we have a WART of 10 years and a debt facility that we know we're hedged against a potential change in interest rates in the next decade, we have a really positive outlook on the fund for the next 10 years, and in a really strong position from that perspective. So that's a bit of background about us, about the fund. What I'm going to finish on is just a little bit about the open fund structure. The clue's in the name. It's an open-ended fund structure. We're always available for subscriptions. We have 4 valuations a year. You invest in a share that's valued, updated once a quarter. We have 4 distributions a year, as I said, and there's 4 redemption windows each quarter. Also 4 different share classes we can discuss with Alan and the team in Finance One. The relevance of the quarter, really, if you invest in Q2, for example, you go on the share register in Q2, you're entitled your first distribution for Q4, and then every 3 months after that. So if you don't invest into Q3, your first distribution is kicked out by 3 months. So that's the relevance of the quarterly flow of the fund. That's it from me. I suppose where we see Greenman fitting into an individual's portfolio, it's really a unique opportunity to generate a stable income from the real estate part of your portfolio. We also provide a really, I suppose, manager-led focus on a non-volatile asset class, and also a focus on the German market, which we think, given the what's going on in a lot of other countries, Germany is safe haven in Europe, has been in modern times, and we think there's no reason why that shouldn't continue. So we really offer people an opportunity to get exposure to the German market, and particularly a non-volatile asset class. So in a nutshell, that's what we're here to provide. Thanks very much.